If you are reshoring all the gold, you let the price rise. Even Luke Groman thinks it'll get to 4, 5, 6, 7,000, and then they'll revalue it. Now, gold is held on every central bank balance sheet in what's called the gold revaluation account. You can't make it up. That's the name of it. If they did revalue it, first of all, it would benefit every central bank on the planet. The Treasury only needs to tell the Federal Reserve, revalue the price of gold right now. And they do. Bang, it's done. No congressional approval. Every $4,000 increase in the price of gold would give the Treasury General account $1 trillion free and clear. If they moved it, as Jim Rickards says, to $24,000 an ounce, as crazy as that sounds, it would benefit all the central banks. It would massively devalue the dollar, to your point, create tons of inflation, but now that would give the Treasury General account $6 trillion free and clear. The Treasury issues gold certificates to the Federal Reserve. The Federal Reserve takes the gold and holds it. Prints the money, the $6 trillion, which devalues the dollar tremendously, just like Roosevelt did in '33, gives the money to the Treasury. Now, the Fed doesn't own that gold, they own the dollar value of the gold. The gold belongs to the Treasury and to the American people. I mean, look, we've become net importers of gold since November. And, there's no coincidence that's when he won the election. The amount of interest that we've seen on all levels, precious metals, since November, and the crumbs that have been left along the way from people such as Donald Trump himself, Treasury Secretary Bessent, Judy Shelton. I mean, on Easter Sunday, Trump says by tweet, "He who has the gold makes the rules," the golden art of negotiating. That comes after massive imports since November. In 35 years, I've never seen that, ever, never. Maybe 1 month here, 1 month there, but now month over month, we're seeing massive inflows into the COMEX. We're seeing the draining of the exchanges and the LBMA and the COMEX. And then you're seeing all sorts of rhetoric that would lead one to believe that things are different this time. And but the interesting thing about it, when you take a step back and you look at the macro picture, Steve, what you see is something that I think really screams to the contrarian in me, and that is that since the beginning of the year, we've seen massive selling in equities by the insiders, the institutionals, the insiders. We just saw Jeff Bezos sell another $5.7 billion in Amazon stock.
While precious metals flow inward, another shift is occurring. Billions in insider stock sales. Jeff Bezos, Warren Buffett, Jamie Dimon, and top executives at NVIDIA have all cashed out massive positions. Institutional insiders have been unloading around $2 billion in equities weekly since mid-2024. At the same time, retail investors now hold a record 54% of the U.S. stock market, surpassing levels seen during the dot-com bubble. Public enthusiasm is at fever pitch, just as insiders exit. Historically, this divergence signals a major reversal ahead. The smart money is moving out of paper assets and into tangible stores of value.
You got Warren Buffett sitting on $500 billion in cash and treasuries. You have Jamie Dimon selling. You have Zuckerberg selling. You have all of the insiders selling. Since June, the institutionals have been selling on average $2 billion per week. You had the top 3 largest shareholders and board members of NVIDIA dumping hundreds of millions worth of stock. Now, this is at a time when the insiders are all leaving and the retail public, the mom and pop, have a larger exposure to the equity market than ever before, including higher than the dot-com bubble at about 53, 54% of all stock ownership is owned by the retail public. At the same time, you're seeing the public really not have much exposure at all to metals on this level. And in fact, Rick Rule often says 0.5%. That's probably being generous. While you're seeing the exchanges being bled dry. Now, to take possession of what amounts to, or to have delivered at what amounts to over 100 billion in gold and silver, 100 billion since the beginning of the year that we know of. A lot of central banks are now admitting to buying privately from local and artisanal miners, not doing it through the normal channels that would get cataloged, like through the COMEX or through import-export numbers coming out of London or Switzerland, but that we know of 100 billion. So the insiders are going deep, deep, deep into physical commodities and actually taking possession, pulling them off of the exchanges.
Insiders are not just buying gold, they're taking delivery. Over $100 billion in gold and silver has reportedly been removed from exchanges in 2025 alone. Some of this metal never shows up in trade data, bought quietly from small-scale miners outside traditional systems. Meanwhile, the average investor holds virtually no physical metals. According to Rick Rule, less than 0.5% of public portfolios include precious metals. This is the largest institutional migration into physical commodities in modern history, and it's happening without public awareness. The public is late, as always, while the elite quietly corner the physical gold market.
While the public is going the opposite direction. So you have massive influx in metals by the insiders and leaving the equities by the insiders. It's the polar opposite by the retail public. What could possibly go wrong? Yeah, I think you're looking at a setup for a very big second half of the year, and I would expect the fall to, I think, show that. The insiders don't take possession in May of $8.5 billion in gold off of COMEX. This is 1 month that we know of, without it being something that they've given a lot of thought to and probably know the playbook, because at that level, those people just don't have the most money. But to take possession of that kind of, or even just to deliver that kind of volume into COMEX is incredibly sophisticated. And it's not something easy to do. You'd be far easier to for someone to give me $500 million and have me go out and scour the world and get them gold bars and stuff than it would be to take possession of metal. Now you're talking $100 billion off COMEX. So something deep is going on, and I would expect that to translate at some point into the retail side, as they're always late. The public is always late after the insider's position. I think that's where we're going. So I'd say buckle up for the second half of the year. Whether or not they're positioning in precious metals, the same people that are selling equities, what I would say is that the big money is leaving the risk of the equity market, which is trading at all-time highs, and really disconnected from the economy. At the same time, the public is going all in on equities when the insiders are leaving. And then at the same time, big sophisticated money is delivering more gold and silver into COMEX than we've ever seen in the history of the exchange, ever. Month over month over month over month over month, we become net importers. These are very sophisticated, institutional, in-the-know buyers, and the public has virtually no exposure at all. So whether they're the same people doing it, probably are, or not, I guess I would just simply say the sophisticated traders are leaving equities and buying commodities. It's the polar opposite for the public.
As capital shifts to hard assets, another trend is intensifying: AI-driven job losses. From accountants to legal clerks, white-collar roles are vanishing. Even junior analysts on Wall Street are being replaced by AI models like GPT-5. With 60% of Americans lacking a college degree and many low-skilled jobs automating rapidly, economic stress is mounting. Median wages are stagnant while living costs soar. The economy may appear strong on the surface, but under the hood, there's a massive shift in employment and productivity. If we don't rebuild domestic manufacturing soon, the middle class could be hollowed out beyond repair.
I don't know how much capital is going to flow into the system in the respect that it's going to hollow out the industrial base of many industries. I mean, you're talking so many jobs will be replaced by AI. What you will have certainly is a separation of wealth. I mean, you'll have a very large group of people who are very wealthy, and unless we bring back our manufacturing, which I do think they're attempting to do, which is kind of my thesis on everything that's happening right now, it'll be a period of serious, I think, stress and pain. But you wonder, yes, it will make corporations perhaps more competitive and more have a sharper bottom line, but what does it do to all the people that had high-paying jobs? For example, my son, who now works at Miles Franklin, we wanted him, his mom and I, to find his way in this world before he came and worked for Dad's company. And so he became an accountant out of college at Price Waterhouse in New York City, getting paid $75,000 a year, barely making ends meet. Without my help, he would have starved to death living in Manhattan at that rate. But
you can't really live in New York City off $75,000 a year, can you?
that's where they started him. But the point is, he was analyzing real estate investment trust balance sheet. Now, what do they need to pay a kid 75 grand with, health insurance and bonuses and whatnot to analyze a balance sheet that ChatGPT and their new accounting software can do like that? They don't.
Yep.
And I mean, the list goes on and on and on and on in so many different fields where do these people go? Now, when you realize at the same time that in the United States, roughly 60% of the country doesn't have a college degree, and you begin to replace jobs, menial jobs, that could have otherwise been done by people, it becomes very scary. You look at like, for example, who needs a stock analyst when you can have ChatGPT do it and present it to the handful of senior financial advisors? Who needs a law clerk helping a judge or a high-level attorney researching case law when ChatGPT can bang like that? So I mean, you can keep going on and on and on. So I don't know how that plays out, to be honest with you.
The U.S. faces a historic debt crisis, $28 trillion in treasuries maturing by 2028, while collecting only $5 trillion annually in taxes. Add $3 trillion in yearly deficits and the math breaks. Foreign buyers like China and Japan are exiting U.S. debt. So how does Washington solve it? By inflating it away. Stablecoin-backed debt, short-term issuance, and financial sleight of hand are flooding the front end of the bond market, but the long end, 10-year and 30-year rates, is rising. Luke Gromen says the Fed is anesthetizing the market. The goal? Quietly devalue the dollar while inflating away unpayable obligations.
There's no question, I believe they're going to destroy the dollar. I think that's what they're intending to do to save the system. Now, how do they do that? I think ultimately you see the stablecoin bill that is being used to flood the front end of the bond market with short-term debt issuance, which when Janet Yellen did it, we saw how beneficial that was for metals and for equities and for cryptocurrencies. And as Luke Gromen, I think, aptly puts it, they want to anesthetize the back end of the market. And here is the thing. When you look at where we're at the back end of the market, the 10-year treasury, you're going to see rates continue to move higher because, just bottling up a few facts, we have $28 trillion due in 3 years in maturing treasuries. That's fact. 28 trillion by 2028. We take in 5 trillion a year in tax revenue. That's 15 trillion. You're halfway there. That doesn't take into account the 3 trillion plus per year in deficit spending. They just came out with their projection for the next quarter. They want to print $1 trillion over 3 months. So the point of it is that 3 trillion per year deficit spending minimum over the next 3 years is another 9 trillion. 28 and 9, 37. We take in 15 trillion in tax revenue. We're, hardly 25% of the way there, basically. So how do you do that? How do you finance that at a time when the rest of the world is shedding treasuries like China and Japan and Saudi Arabia? And now we're supposed to believe that the United Kingdom, one of the most indebted nations in the world, is buying the debt of the most indebted nation of the world. They're number 2, and the Cayman Islands and Ireland. The whole thing is a shell game. So what I believe that they are going to do is, first and foremost, let's look at, we've become a net importer of gold, and month over month we're seeing massive inflows of gold every single month. I asked Judy Shelton, who was Trump's nominee to run the Fed in 2016, do you think that they're going to issue gold-backed treasuries? That was what her book was all about. On my interview with her, she said there is no question, in no uncertain terms did he say to me, July 4th, 2026, he will do that. It's a big day for him. It's the 250th year anniversary of the country, and he will issue gold-backed treasuries on the back end of the market that day. Now think about this.
Whispers of a gold-backed financial system are growing louder. Judy Shelton, Trump's former Fed nominee, claims a new gold-backed treasury bond could launch on July 4th, 2026, America's 250th birthday. If the U.S. revalues gold to $7,000 or more, it could unlock trillions for the Treasury overnight. This gold revaluation account, held on every central bank's balance sheet, would allow governments to print money while appearing solvent. The Fed could credit trillions to the Treasury without congressional approval. It would crush the dollar's value but bail out the system. For insiders hoarding gold, this may be the real endgame.
If you are reshoring all the gold, you let the price rise. Even Luke Gromen thinks it'll get to 4, 5, 6, 7,000, and then they'll revalue it. Now, gold is held on every central bank balance sheet in what's called the gold revaluation account. You can't make it up. That's the name of it. If they did revalue it, first of all, it would benefit every central bank on the planet. The Treasury only needs to tell the Federal Reserve, revalue the price of gold right now. And they do. Bang, it's done. No congressional approval. Every $4,000 increase in the price of gold would give the Treasury general account $1 trillion free and clear. If they moved it, as Jim Rickards says, to $24,000 an ounce, as crazy as that sounds, it would benefit all the central banks. It would massively devalue the dollar, to your point, create tons of inflation, but now that would give the Treasury general account $6 trillion free and clear. The Treasury issues gold certificates to the Federal Reserve. The Federal Reserve takes the gold and holds it. Prints the money, the $6 trillion, which devalues the dollar tremendously, just like Roosevelt did in '33, gives the money to the Treasury. Now, the Fed doesn't own that gold. They own the dollar value of the gold. The gold belongs to the Treasury and to the American people.